Today, we're going to throw the spotlight on one of Warren Buffett's favorite metrics, the return on equity, or commonly known as ROE. I'm going to talk about how it is relevant for us as retail investors and also touch on three stocks with high ROE that you might be interested in. With that, let's dive in. Okay, for starters, what exactly is ROE or return on equity? It is a financial metric that measures a company's profitability by assessing how efficiently it uses the equity to generate profits. Okay, so the formula here is to take net income divided by the average total shareholders' equity, and this tells us how much profit a company is making for every $1 of shareholder equity invested. Okay, so let me put it in layman terms, right? So take for example, you invest 100,000 of your own capital into a food store selling Western food, and this is your equity, your 100,000 equity. After deducting all the expenses like food ingredients, rental expenses, and your own salary, you still make a net profit of $10,000 a year. Okay, this means that your ROE is 10,000 divided by 100,000 of equity equals to 10%. And assuming you do a good job with your food store and gain a competitive edge, like you invent this durian flavor chicken chop, and there are a lot more customers and you can charge a much higher price, in turn you make more money, right? And your ROE go out from 10% to 20% now. So in short, now why ROE matters so much to Warren Buffett and especially to us as investors. To add on, throughout the many interviews Warren Buffett has given, he has always emphasized on the importance of ROE in his investment philosophy. This is simple, right? Because companies with consistently high ROE tend to imply that they have a strong competitive advantage and is able to utilize their capital efficiently, either through investing in new ventures or doing share buybacks when the stock is considered undervalued. And in essence, Warren Buffett actually hunts for this kind of companies that can compound their wealth over time instead of a one trick pony. This is also the reason why we should focus on ROE, because this is such a popular measure of profitability and good corporate management performance. Now, let's move on to our three case studies that I have screened out with over 15% ROE and analyst consensus upside of more than 15%. Okay, our first stock on the list is none other than Sheng Siong Group. If you don't know what Sheng Siong is about, that means you don't go enough grocery shopping. All right. So here's a quick corporate profile. So Sheng Siong started off as a small provision shop in Ang Mo Kio and has grown to become one of the leading supermarket operators in Singapore. So right now they have over 65 stores island-wide, and I believe they have three or more stores located in Kunming, China itself. So they are, I believe that Singapore is saturated for them, and they are trying to expand overseas into China, where there's so much opportunities over there. Okay, coming to the financial performance, all right, of Sheng Siong Group. Okay, from this graph over here, you can see that in the past decade itself, the revenue have and the earnings have been growing up steadily, as well as the free cash flow, the purple line over here. So in short, right, this is a very profitable business. All right, and let's see how is the ROE like. Okay, so if you were to look at the ROE, okay, in this section itself, analysts are predicting that the future ROE of Sheng Siong to be around 27.5% in 3 years' time. So 27 is a very high figure for ROE, and especially when you compare it to the industry ROE of only 9.1%. Okay, and with that, let's look at their valuation as well. So valuation, so analysts are saying that, okay, their share price has fallen by a bit since the start of 2023, and right now it is trading at around $1.50. Analysts are predicting an average 1 year price target of $1.91, translating into a potential upside of 27%. So with that, let's move on to the second stock. Before we get into the next US case study, don't forget to hit that subscribe button and ring the notification bell so you never miss an update on this kind of smart investing strategies and all the stock investing ideas that come with it. And as usual, here's a financial meme for you. Okay, now let's hop across the Pacific and look at the US stock with high ROE. In order to do that, you can just change the market in the Simply Wall Street stock screener. So you can just change from Singapore, okay, you untick and then go to the US market. So the results come out very fast, so fast that it's like seamless. And over here, you can actually sort by the market cap, PE ratio, the dividend score, and all that, and go from high to low or low to high. And if you're interested to do the research on your own, you can actually sign up for a 14 days free trial in Simply Wall Street itself if you sign up using my affiliate link below. Okay, and thereafter, if you want to sign up for the premium plan, you can get a 40% off. So instead of $10 per month, you can just pay $7 per month to get access to this super fast stock screener, 30 company reports like the one I'm going through right now. So without forgetting about our US stock, let's go for uh, Pepsi Co. All right, Pepsi Co. is the one I've chosen for the second case study because it is a company that we are familiar with. Okay, sorry. Okay, you can have they have all the products that we are familiar with like Lay's, Doritos, Pepsi, 7 Up, Mountain Dew, and more. Okay, on top of that, right, if you look at the past financial performance, their revenue has been growing up steadily, but their earnings have like hit a plateau where it's stagnant in the past decade. That being said, the free cash flow, it is a free cash flow generative company. So although the earnings have not increased in tandem with the increase in revenue, the company still manages to uh, churn out free cash flow year on year basis. Okay, looking at the ROE, okay, which is 3.4, that is something that as investors we should take note of, is that although the ROE for Pepsi is very high at 44.7%, the matrix is skewed because of their high level of debt. So what does it mean? So Pepsi borrows a lot of money, and in return, right, their ROE is somewhat like skewed higher. So industry maybe is average of the industry is 17%, but for Pepsi itself, it went up to as high as 44.7%, probably due to their excessive use of debt. Okay, and in this regard, right, I actually uh, wanted to switch over to another stock, which is Adobe, to share with you the difference. Okay, so over here, if you were to scroll down, you look at the ROE of Adobe. Okay, it is also pretty high at 32.5%. However, Adobe one, okay, there's no high borrowings involved. So this translates that this may indicate that Adobe have a relatively strong competitive advantage, which let them have this kind of high ROE and this advantage over the competitors itself. And now let's look at the valuation part. Okay, so for Pepsi itself, they are currently trading at $167, and their average 1 year price target is $197. So this translates to around 17.6% potential upside based on the coverage of 19 analysts. And if we hop over to Adobe itself, okay, you scroll down to the analyst price target, you can see that right now it is trading at around $507. The average 1 year price target of Adobe is $582. So that translates to around 15% potential upside. And there's one thing to note is that this is based on 34 analysts compared to only 19 analysts for Pepsi. So Adobe has much more analysts covering the stock itself. Probably because they are more like a tech company, and they are more the market cap is around the same at 200 plus billion, but Adobe may have a more sexy growth story that analysts want to cover. Okay, so with that, let's go and talk about the third stock on our list, Mr. DIY Group from Malaysia. Okay, for the final case study that we have, here is Mr. DIY Group. Okay, so Mr. DIY Group is one of the leading or largest home and life improvement retailers in Southeast Asia. So you would have probably seen the outlets in Malaysia, Singapore, Brunei, and all that. Okay, so on top of that, right, if you were to look at their corporate profile, you will have seen that they have 3,000 plus stores across Asia and over a variety of 18,000 products. So that is, I would say, like a economy mode by itself, whereby they have so many stores, they are able to procure these products at a much lower cost, and they have a cost advantage. That is the reason why they can also sell their products at a very low price, beating out all the competitors out there. Okay, so without further ado, let's jump into the financial performance of Mr. DIY Group. Okay, so over here we can see that their revenue have been growing at a very steady clip. Okay, from 827 million ringgit to 4.2 billion ringgit in a matter of just 6 years. So that is around, I would say, a five times of revenue in a matter of 6 years. That's very impressive. Okay, so if we were to take out the revenue itself, you can see that the earnings have also followed a similar trajectory. Okay, going from 146 million ringgit in FY 2016 to 515 ringgit in FY 2023. Okay, so on top of that, if you were to look at the cash flow, they are also a very cash flow generative company. So now let's look at their ROE trend. Okay, Mr. DIY also have a very high ROE, signifying that they have a somewhat a sustainable competitive advantage. So 32% is pretty high from what I would expect, because they are a more physical retailer, and I would assume that their ROE is maybe in the low teens instead of a 32% ROE. So if you compare it to the industry average of 13%, it is much higher compared to the industry average of 13%. So on top of that, if you look at the valuation, okay, let's look at the analyst price target. So based on the coverage of 15 analysts, they are saying that the Mr. DIY group has an average price target of around $2 ringgit. Okay, that translates to around a 37% potential upside, which is pretty significant. Okay, and One thing to note is that their share price has actually fallen by quite a bit since their IPO from maybe $2.50 to right now is only $1.50 for their share price. Okay. To wrap up, the ROE can be a valuable tool for us retail investors to assess a company's ability to generate returns for shareholders. Moreover, this is a financial metric that we can use to screen out interesting stock ideas easily using platforms like Simply Wall Street, which I just demonstrated. Alright, speaking of which, you can give Simply Wall Street a go for 14 days because there's a free trial going on by signing up using my affiliate link down below. Okay, with that, if you find this video helpful for you, do remember to help me tap the like button and subscribe to my YouTube channel for more of such investing related videos. So with that, you can also check out this video over here for more stock ideas. And I will see you next time. Thanks for watching and ciao.